John Wyn-Evans, Head of Investment Strategy at Investec Wealth and Investments. Are you ready to play the Edison bull or bear game?
I certainly am.
ETFs.
Neutral.
Cryptocurrency.
Neutral.
Inflation versus deflation.
Short-term bullish, long-term slightly neutral to slightly negative.
Global versus UK equities.
Bullish.
US dollar.
Neutral to slightly negative.
Oil price.
Small bull.
The Reddit rebellion.
Neutral to bearish.
Value versus growth stocks.
Neutral in the short term, long-term preference for growth.
Gold price.
Mildly bullish.
Net zero trends.
Very bullish.
British and Irish Lions over South Africa.
Bullish, obviously.
And lastly, Rafa Benitez.
Well, as an Everton supporter, I have to say I'm bullish, just because you have to have that unfounded optimism in your football team. But I'm sure if we get a few bad results, we'll turn bearish very quickly.
Okay, very good. Well, thanks very much for playing, John. I guess there's lots of topics to discuss there, some really interesting ones that I want to ask you about. And obviously, you've given a lot of thought into time frames, which is always good. You know, for those of you of our listeners that might not be that familiar with yourself, are you okay just very quickly to describe your role at Investec?
Absolutely, yes. So as Head of Investment Strategy, my key two roles really. One is to chair the Asset Allocation Committee. So that's where we deploy, our assets on a tactical basis at the key asset level. And then also I do an awful lot of the written output in terms of things like a weekly digest that goes out every Monday evening to clients and intermediaries, and also big sort of monthly commentaries on the market as well. And in normal times, I'd spend quite a lot of my time running around the country doing lots of conferences and presentations, but obviously in the current world, that's been confined more to online, which in some ways is better, obviously, because you don't have all the travel, but in other ways, it's, you miss meeting all your clients and potential clients out there, and indeed your colleagues in all the different offices. So looking forward to some degree to getting back to doing a bit more of that again in the future.
Yeah, okay, great. Yeah, and I think that's echoed by many of us. One of your answers, global versus UK equities, I think you mentioned that you're bullish on global, is that right? Or are you okay to elaborate?
Yes, I mean, I think I've maybe sort of slightly taken this out of context, perhaps, but to say that we are, within our process internally, we are moving towards a greater sort of embracing of global equities in particular. So, whereas historically, I think amongst quite a lot of the wealth management community in the UK, there's been a greater emphasis on the domestic markets. I think we and others certainly feel that there's a much bigger and deeper pool to fish in globally, and therefore one can take advantage of that. And certainly, as we've seen in the United States, just the depth and caliber of companies that they have over there, world leading in all sorts of different industries. You can't cut yourself off from that pool of talent, as it were. You have to have the ability to range across the world in terms of looking for the best opportunities for investors, particularly potentially in a world where we may well go back to a lower growth phase at some point in the future, and whatever growth there is will be still highly valued.
Yeah, and on a similar related theme, I guess, looking at value versus growth. So the whole UK is described by many as a sort of more value, more slightly cheaper industry than many of the global markets. I think you said longer term, you're bullish on growth. Is that right?
Indeed, yes, and I think we're trying to get away a little bit from the labels of value versus growth. Some people might describe it as cyclical versus defensive. We tend to look at it more as short duration versus long duration, and particularly, it's been, you could say, a growthy market for the last 10 years. We'd say more accurately, it's been a long duration market for the last 10 years or so, and obviously with bond yields and discount rates where they are, that's been highly beneficial. But I think it's the ability of those growth companies to continue to generate very strong returns on capital and to reinvest into their businesses and compound those returns, which is the really compelling aspect of those longer duration stocks. One feels more with value companies, much more of that is about a reversion to the mean in terms of value, but then it's very difficult to get the timing on those things, and also what you do for an encore, you have to go looking for the next one every time. And in a funny kind of way, you could say that something like Amazon has been the greatest value stock of the last 20 years, because people have consistently underestimated what it can achieve. So if you look at it through the Benjamin Graham lens of intrinsic value, perhaps rather than just absolute value in terms of a PE or a book value, I think one has to widen one's horizons a little bit in terms of definitions these days.
Yeah, sure. One topic that you were very adamant on, very clear, net zero trend. I guess how does Investec approach the whole ESG and climate change, and then is this something that your clients are more increasingly asking for?
Yeah, I think this is. I mean, it's a fascinating area, obviously, but it's also one which is, has an existential threat to us as well. So it's in your personal life as well as your investing life, and this is hugely important. In net zero, we're seeing more and more, governments around the world setting targets. We've got the big COP20. I can't remember which number it is now. 25, 27 in Glasgow. Later this year, and there's no doubt about the fact that I think the sort of net zero train has left the station, as it were. It's just a question of how fast it's going to go. And certainly, for example, if like me, you live in London and you have a car that's not compliant with the ULEZ restrictions now, the ultra low emission zone, from October, you're going to have to pay to drive just for pulling out into the road, basically. There, so you can see that these are things that are definitely going to change, consumers' behaviours in the future. In terms of embedding it into our process, we have for a while been looking at the sort of ESG and sustainability factors from the company perspective, and certainly it's easier to measure those than it is, I think, the environmental side, particularly in terms of carbon emissions, for example. Everyone has sort of gone down that route fairly quickly because it's a relatively easy, but at least there's some transparency and data is given out about carbon emissions. Governance is at the other end, is the other factor, which again, in terms of kind of inclusivity in boardrooms and such like, has been able to have been adopted fairly quickly. I think it's the S in the middle, which is turning out to be kind of the harder bit to do, as it were. And I think even within the whole ESG framework, you have to ask yourself, what's good on one side, is it good on another? So to take for an example, if carbon pricing is to rise, for example, and it puts up the price of international travel and flights and such like, does that mean that there's a huge chunk of the population which can't afford to go on overseas holidays anymore? Is that socially inclusive or not, for example? So I think there are lots of very interesting kind of anomalies that are come out of this, and how we manage to sort of build them into long-term policy. The thing I think that we're wrestling with currently internally is how to embed the whole ESG and sustainability outlook into our strategic asset allocation process. And again, some of it is captured in the bottom up at the company level. You end up double counting it at the top down level what's going to be the outlook for inflation, for government bond prices, for future growth, all of these things in the future. I think this is going to be a really quite, I don't know whether difficult time, but challenging time for the industry in coming to terms with all of this. And certainly, as you ask, clients are definitely becoming more interested in this. But I think as time goes by, as family money flows down from the older generation, let's call them the baby boomers, for now, down into younger hands, into the hands of Gen X and millennials, I think there will only just be an ever-increasing focus on these trends, and we certainly expect to be highly involved in that.
Okay, great. And moving on to cryptocurrencies, remind me, John, were you neutral on cryptocurrencies? And I guess we've had a lot of comments about illicit trade and government regulation. Are you on the bubble side of crypto, or do you see it as being a nice hedge against inflation?
No, well, I certainly wouldn't see it as being a hedge at the moment. It's a very difficult. First of all, it's a very difficult thing to integrate into portfolios because it's a highly sort of volatile area, and there aren't really sufficient vehicles in which to do it, particularly in a sort of wealth management organization. And I think the difficulties as well, people just talk about, Bitcoin and cryptocurrencies, but I think one has to differentiate between the underlying blockchain technology, the cryptocurrencies themselves, central bank digital currencies, which I think are going to gain more prevalence, and certainly China's leading the way on that particular front, and the whole sort of issue of decentralized finance, or DeFi, as it's known as well. They're all very separate in their ways, even though they all kind of have the same underlying kind of philosophy to them. And there'll be some areas in which there is definitely opportunities and money to be made, and which will cause great disruption, and others where maybe it'll be more like the status quo. But certainly at this stage, from a client portfolio perspective, we found it very difficult to incorporate any of this sort of new technology into portfolios currently.
Understand. Okay, and moving on, interesting topic, the whole Reddit rebellion that we've seen with GameStop, AMC. Some of my friends outside of the industry are adamant these stocks are going to keep on going higher and higher, and it's got to be a bubble, right, John?
Yeah, I mean, I think the individual stocks that are being kind of moved by a small group of traders, at some point they have to find, gravity comes to call, in that there has to be some reference to the profitability of the underlying company, and what the cash that it generates. You can't just send something to the sky forever and no, it won't revert to some normal valuation at some point. I mean, I think the key thing is when you look at the stocks that are involved here, they're generally reasonably small, and I don't think they present any systemic risk to equity markets overall. Yes, as we know, with GameStop early in the year, there was one particular hedge fund that got disadvantaged by that, but again, there was no sign of systemic risk. So I think for those people who are enjoying the ride of this, great, make the most of it. And I don't think we can also kind of discount the fact there's an element of sort of social capital involved in people kind of coming together in online communities and message boards and enjoying the fun of trading in markets. But I think I would hesitate to call it investing at this particular point. I'd kind of think it more as kind of Mimecast with real money, perhaps, or something like that. Yeah, it's an interesting phenomenon. It's a sign of the times. It's a sign of the kind of the accessibility of financial markets to a wider number of people, which cannot be necessarily a bad thing, I don't think. It's also a sign of the amount of liquidity that's in the world at the moment, so which maybe is possibly less positive. It's being put to more speculative uses, perhaps. As I say, I would hesitate, to say that this is necessarily going to be something that can bring down the markets as well.
Okay, noted caution, perhaps. Moving on finally to this interview is being recorded before the first British and Irish Lions test with South Africa, the first game. Will there be a lot of banter within Investec, given your colleagues in South Africa, and how do you see those 3 games playing out?
Yeah, well, yeah, certainly. As you know, the South Africans are passionate about their sport, so certainly we will get a bit of a back and forth between ourselves and our colleagues down there. And as you may or may not know, Investec actually does a lot of sports sponsorship. I remember on my one of my trips to South Africa, it doesn't matter where you look, even on a very small bowling green that I passed at one point, I could see an Investec piece of advertising there. So it's sort of embedded in the culture of sport in South Africa. I mean, certainly, as you know, I think the Lions have the advantage of having played a little bit more rugby recently, and therefore, theoretically, could be in a better sort of position organisationally. But there again, as we know, the South Africans are very, very aggressive performers, and I'm sure it's going to be a highly physical contest. As a Welshman, I'm very pleased that Alan Wyn-Jones has miraculously recovered from a dislocated shoulder in less than 3 weeks. I think that's amazing. So, as a talisman for the Lions, certainly he can be very important. And certainly I'll be cheering them on very strongly come the weekend.
Yeah, sure. We wish him the best. It's going to be a close couple of games. So we look forward to that. John Wyn-Evans, Head of Investment Strategy at Investec. Thank you very much for playing the Edison Ball or Bear game.
Thank you for having me.